Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And hey, welcome. This is the second hour of the Investor Coaching Show right here at Super Talk 99.7 WTN. Paul Winkler along with Jim Wood on this crazy news day. Khomeini is no longer with us, according to the Wall Street Journal, has been announced, and that has been interesting. Trump rolling the dice on the regime change is what the Wall Street Journal is saying. Rolling the dice, and anytime you have uncertainty, as we talked about in the very first hour, if you didn't check that out, if you didn't hear us on that, talk a lot about how markets work historically when it comes to these types of things. If markets go down, people worry about, they complete the pattern in their minds. If it goes down, the stock market, and we don't know. You don't know how the market's going to open Monday. I mean, you could have all kinds of crazy stuff go with futures markets. They'll talk about what markets are going to open, how they're going to open. But the reality of it is you don't know what's going to happen until it happens. And when it does go down, recognize that what is going on is people are saying, I am taking on the new risks that are out there. I won't pay as much for them because there are new risks out there. I won't pay as much for stocks as I would have on Thursday, let's say, or Wednesday of last week. So what will happen, people will lower the price that they're willing to pay. And what they're doing is they're building in for themselves a higher expected return into the future. If you look at market downturns historically, number one, you look at how long they last. It's historically not that long. Since 1956, you've probably heard me say this before. The last study I saw on it was that the market goes down and it comes back within 111 days. Historically, I mean, sometimes it's shorter, sometimes it's a little bit longer, but that's about it. And hence I don't really worry about all of this stuff. This is why, as we get older, as an investor, as you get older, you want to add fixed income investments to the investment portfolio, typically based on your situation. But you're normally adding fixed income, and the type of fixed income that I always add when I use fixed income investments. And when I say fixed income, I'm thinking cash, money market accounts, bonds, those types of instruments. Very, very safe, very high quality, short duration, so that if you have market declines, those types of bonds tend to go the other direction. They tend to jump in value when markets decline or when you have precipitous declines. That is what we see throughout history, is that. And the reason being is because what happens? Interest rates tend to go down. And when interest rates go down, bond prices go up. So hence that's why we do that. It's kind of that teeter-totter, so to speak, of, you think back, teeter-totter, one side goes down, the other side goes up, the other side, and it goes back and forth. And that is why we invest the way we invest. Very, very critical.
I always think, too, that people worry about the uncertainty. Okay, there's this possible war that's going to go on. We don't know what's going to happen. Mm-hmm. But we think, okay, oil prices are going to jump. Mm-hmm. Well, that's not necessarily bad for the market because, part of the market is oil companies.
Well, sure. Yeah. And not only that, you look at that and say, okay, so there may be some companies that benefit from all of this, but there's also the whole idea here, and they're talking about that there's a possibility, it's the single greatest, and this is a quote, the single greatest chance for the Iranian people to take back their country. Well, what does it take for an economy to thrive? A couple things. And we said that stock markets can go down when the economy is not thriving. So I'm not saying that the economy has to thrive for the stock market to go up. I'm not saying that. But what I'm saying is, what does it take for an economy to thrive? It takes demand. So this is why we're always looking at consumer confidence. And we're looking at these numbers on a regular basis and say, how confident are people that the economy is going to do well in the future? What does consumer spending look like? Are people opening up their pocketbooks? Are they kind of, stashing money away because they're nervous or they're scared? We look at these numbers because it impacts markets and it impacts we look at the profitability of companies is impacted by this, right? Well, what if you all of a sudden have a large mass of people who feel more confident about their future? and feel like maybe the sky is the limit. Maybe things are going to be good. Maybe we are going to get the opportunities that we've been hoping for forever, but we've been held back because of our government. I'm just speculating that may be a possibility of the positive outcome of all of this.
Absolutely. Just new open markets, freer markets, better property rights. One of the examples I use a lot with clients is, because I'm in my 60s, early 60s, and back when I was a kid, over half the people lived below what was considered the poverty line.
Level. Yeah.
And today it's about 15% or less, so 1.5, going from 5.0 to 1.5.
Yeah, isn't that something?
And means that's new consumers, new markets, new products, and all that. And that's right back to that theme we were talking about earlier, healthier and wealthier. And certainly if something like this, and same thing in Venezuela, if it can free up these countries to where that their people have opportunities, can create businesses, can expand their economy, that type of thing. I mean, you look back at the pictures of Iran before the Shah fell years ago, and people walk around, it's beautiful, they're in modern clothes, everything, it looks like a very modern, incredible, just kind of, to use the word, normal country, and doing very, very well compared to kind of what it is at least today.
Well, it's like Venezuela. I mean, you look at the same thing. Sure, yeah. And people forget that it was one of the wealthiest countries going, and when just the growth, it was fantastic, until all of a sudden you have a group of people come in and they just tear it apart.
Yeah,
economically. And it's the other thing that's interesting about that, Jim. You talk about these people doing well and what could happen and where are they going to lead to? Where's it all going to lead to? I look at, what opportunities for exporters to those countries and how companies that export products could benefit and how the Middle East could change the whole dynamic over there, could change for the better. Right.
I mean, Iran being one of the biggest, if not the biggest, exporter of terrorism and all the different groups around the world, how can that benefit so many other countries out there if, people aren't worried about, getting bombed, getting, people attacking them in the middle of the night, et cetera. Just remove some of those threats, because all those threats, to counteract them, there is an enormous cost. And both, certainly in blood, to get a little gruesome there, but just the cost in terms of deterrence and the weapons and things like that. And if that's money that can then go towards better lives for everybody. So it's just kind of, the possibilities are really, really great. We don't know how anything's going to go, but it certainly, I think, at least shows some opportunity out there.
Yeah. And not only for that particular country, for other countries around it that don't have to spend money on all. I can think about defense and taking care of themselves, and how much you have to be on guard all of the time, and the opportunity costs that come with that. Opportunity costs being the idea that I'm spending money on one thing, and that forces me not to be doing something else that I would rather be doing with that. And just, I think it's. I sit back and watch this stuff, and I don't do it in fear. I look at it as, hey, this is interesting how the world changes. And we think, wow, the world is just crazy right now. And I'm like, well, the world has always been crazy.
Right. That's kind of back to that wall of worry that I mentioned earlier. Just like over the years in our lifetimes and before our lifetimes, I can't imagine. I mean, all the bad stuff we think about today, you look at that old footage of World War II and even World War I and what people dealt with, and, things we kind of complain about today. We look at how our parents lived, how they grew up in, smaller houses, they worked hard, they saved money, and it's just, and things just right now, like I said, seem pretty darn good. We're always trying to make things better for more people. But I guess that's why I'm a rational optimist.
You are that, and it is a rational thing. So there was something I was going to talk about, and it just escaped me because it was you had mentioned that people living and below the poverty level, and how that has dropped over the years, and how much that has dropped. There was something I saw this week, and oh man, it'll come back to me. I'll have to bring it back up because it was, to me, one of those things that I hadn't really thought a whole lot about. And oh man, I hate it. I can't think of it now. I thought it was going to come to me. But it's
in the middle of the night. Boom.
No, I don't want it to take that long. Okay, so there was a question that came in, and I thought I would address this right here. Matthew, thanks for this question. The question was this, and I'll just throw it to you, Jim, and then you can answer, and I'll just fill in whatever blanks. And by the way, that's one of the things you can do is you can ask questions on our website. You go to paulwinkler.com/question, paulwinkler.com/questions. Either one will get you there. Or if you go to paulwinkler.com and just go to content, you can ask questions there. The question was this: good afternoon. Heard you on the radio. Financially, I'm barely floating, but I don't want my child to struggle when he grows up. I get extra money from the VA and would like to put that away for him when he grows up. Would you recommend a Roth IRA or other investment that I can pour into for him? Okay, so question, Matthew, you get the gist of it, yeah. Jim. Mm-hmm. What are your thoughts? And I'll fill in whatever you.
Well, my first question is, how old is the child?
Perfect. Yes.
Because that can certainly have an impact. And then, you start looking at the options, and he mentions Roth IRA.
Does a child have earned income?
Yeah. That was where I was going with that.
Okay.
So there's the Roth IRA. That's if he has earned income, that's a great choice as long as the money's for retirement. So that money, if it's a 10-year-old child, that means that's a 50-year investment.
And why is that such a good option for a child? Why is a Roth such a good option? Because so often we talk about pre-tax, where you get a deduction to make the contribution, then you pay taxes later on, versus a Roth. Why is that?
Well, it's 50 years of tax-free growth. And so because if you take Roth out past 59 and a half and the account's been open for 5 years, then once you come out, including earnings, you don't pay any taxes on.
And what is the child's income tax rate typically right now if they've got very low income?
Yeah.
Zip.
Right.
So with a tax deductible IRA, if you're deducting it, but the tax rate of the child is zero, you're not getting any benefit right now. And then you're going to pay taxes later on. Roth being better because you don't get the tax deduction now, but you're not paying any taxes. So this is one of these things that if you look at this, say, well, the child doesn't have any earned income. If a person has a business, and I don't know, Matthew, you've got a business or anything like that, but I'll find there people will do work, kids will do work, any kind of work. I would think about cutting grass or those types of things. I think of dentists. Quite often, you look at a dentist office and you see an ad for a dentist office. You'll see their whole family in the ad. Why? Because they're paying their family modeling fees, and they pay their kid a modeling fee for being in the ad. And then they can go and stick the money in a Roth IRA. So a lot of times that's used for that. What is another option if this is a younger child? Another option could be this. And let's say that they don't have earned income, but you wanted to get into a Roth IRA. If it is a younger child, you may think about putting the money into a 529 plan. Now, a 529 plan is an education account. Each state has them. I'm not a big fan of Tennessee's. But all these states have them: Kentucky, New York, Virginia, Ohio, all of them. But they'll have different states. Now, some states I like because they actually use investment vehicles that are not gambling with your money. Not buying, selling, trading stocks and those types of things. I happen to be a fan of Utah's plan. Just because of the way they do it. But you got to watch out how you invest it. So I'm just going to put that out there because you have a lot of different investment vehicles, and making sure this is something we do for clients all the time is choose the investment vehicles and have the portfolio change as the child gets older. So you can actually, that's one of the things I love about their program, As we can set up the asset mix. Now, 10 years from now, you're listening to this show, it might be a different state. It used to be I liked Nebraska's plan. Before that, I liked West Virginia's plan. So don't get married to the idea of a certain state's plan. But I'm just telling you at this point, that's one I tend to use. Here's what happens. Is if you set this thing up for a young child, if they go to college, you can actually use that money tax-free for tuition, expenses, and those types of things at a college. If the child does not go to college, now the new rules state that you can actually convert this thing to a Roth IRA after 15 years. Now you're limited to the contribution limits to the Roth IRA each year, and I think the maximum is like $35,000. Is what the total maximum is that you can actually move from a 529 to a Roth IRA. But that is another way to slide into something like that. If none of these are an option for you, let's say it's an older child, maybe they're not working or they're not eligible for a Roth IRA or something like that, because you have to have income levels that are of a certain level, and it's pretty high income level to where you won't be qualified to do a Roth IRA. But here's the thing. Sometimes I use non-qualified accounts where I don't have any restrictions to access of the money later on. Non-qualified account, when you invest it the way we prescribe on here, where you're not buying, selling, trading, and gambling with the money, you're dealing with capital gains taxes. Now, the capital gains tax rates, is, in other words, if I buy an asset for $10 and it grows to $15 and I sell it, I have to pay capital gains taxes on $5 of gain. Now, for right now, as we speak, the capital gains rate up to a 22% tax bracket is zero. So for a lot of people, non-qualified accounts are a pretty good alternate source for saving for something where you don't have the government telling when you can get the money and when you can't get the money. Because recognize you can have a penalty on gains with Roth IRAs. So if I put $5,000 in and it grows to $12,000 and I pull it out before 59 and a half, I might have a tax on that $7,000 gain. But recognize with Roth IRAs, here's the other thing that a lot of people miss, is your principal comes back tax-free. And that's the first thing that comes out. So if I put $5,000 in it and grew to 12, I can actually pull that $5,000 out tax-free, even before age 59 and a half. So, there are a lot of benefits to that, but this is one of those things you want to definitely have a planner that knows the situation and walks you through all of that. Go ahead, Jim. You were going to say something about that.
Well, no, I was just thinking because the three things I talk to clients about are the Roth IRA and the brokerage or after-tax account, and of course the uniform transfer to minors account, custodial account.
Right.
And I was just thinking, like right now too, the one other possibility is a Trump account.
Right, and I hate them.
Yeah. Well, I think with
take the $1,000 and don't contribute anymore.
Yeah.
Because the tax treatment is not good on those types of things. It's subject to regular income taxes. It doesn't get the capital gains treatment. So I'm not a big fan of those things for that reason. So anyway, yeah. Why did Slot actually like those?
No.
Oh, good.
No, I mean, it's just something, but they were talked about, just in how they work. And
okay, yeah.
Thinking,
we can talk about how they work, but I don't want one. Yeah. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds, all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. Hey, what's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, we're back here on the Investor Coaching Show. Paul Winkler. So Jim and I were talking during the break, And he brought up the Trump account, and I was like, yuck, 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 yuck. And there is a possibility. There's a possibility. And we're waiting for the dust to settle on this one, that you can convert it to a Roth IRA. There's a possibility. If you could do that at age 18, if you could do that, that would totally change my mind about these things. And it's like anything else with regards to tax law. You know, when stuff comes out, it's brand new and nobody knows anything. There are things that have changed, the tax laws have changed on 3 years, 4 years ago. And we still don't know what you can do.
Right. Now, IRS is playing whack-a-mole, trying to whatever, is actually beneficial to the people. They're trying to take their little hammer and, make sure people can't do that. But this appears to be one, and especially at age 18, you're not likely to have a huge income. So there might be some real opportunity there. If somebody had that, Trump account, even if they took the $1,000 and it grows for 18 years, you turn 18 and maybe now that 1,000's 5,000.
Yeah.
Convert that to Roth, and it's going to grow for another 42 years.
Man, if they do that, you'll get. Now, I don't like the way they're invested.
Yeah.
I'm not gonna. If they make you stay with the same investments that they've got, I wouldn't be terribly happy about that.
Only up until age 18.
And if they let you change the investments, and here's the reason. Typically, when we look at how they invest, they have, up until now, they've been saying that it is just in an index fund, broad U.S. index fund. Like if you look at a total stock market fund or an S&P 500 index, you're just not diversified. You're basically concentrating all of your money in the area of the market that has the lowest long-term expected return. Now, if I'm looking at, let's say, a 30, 40, 50-year period, that money will be invested. And you look at large U.S. stocks versus, let's say, small companies or value companies, it's not a small amount of difference between those two things. Look at, for example, if we look at historically the return, let me just take, I'll just use, let's say, $1,000 contribution. I'll use that as an example, pulling out my calculator, and let's say we use the long-term rate of return of the S&P 500 to 10, and we're looking at a 50-year period. Let's just use that as an example. That $1,000 over 50 years grows to about $117,000. That's large U.S. stocks, a historic return on that. Now, if I look at value companies and I look at the rate of return, long-term return of small value companies, and I do that, instead of $117,000, it's $700,000. So you look at that and go, wow, that is a huge difference.
That's real money.
Yeah, that is a huge difference. So if they start to allow greater diversification, later than that, it's no big deal if you don't get a lot of diversification for 18 years, let's say. And I can see why they do that. It's kind of like the TSP, the Thrift Savings Plan. With the Thrift Savings Plan, they just don't allow a lot of diversification with government employees with the Thrift Savings Plan. They got a C fund, which is the S&P 500, an S fund, which is a completion index, which is basically where the S&P 500 leaves off, and then an I fund. I'm like going, oh, gosh, lowest long-term returning area of the market for U.S., lowest long-term returning area for international, and then a completion index, which is basically mid-cap funds, which is more mid-cap-ish, which is not an area of the market that I like to focus anyway, at all. I don't typically have that in a portfolio.
Fun fact, want to know the form that you have to use to file for a Trump account? What form you have to file?
I give up. What?
Form 4547.
Oh, gee. Seriously?
Seriously.
That is funny.
I like that when I read that.
Yeah, of course. Why does that not surprise me at all? That's funny. That is a possibility. We'll put that as an addendum on that last little segment there, Matthew. But, good question regarding... what can you do? And, just in general, taking care of and helping out the next generation, teaching them about money. The one thing I do like about all of these types of just investing in general for younger people is just give an idea how markets work, where returns come from, educating them. That's going to be a big push for us going forward, is just making sure that younger people understand what they're doing, why they're doing it. And having parents pass this information on is really good because the studies show, as much as I've heard this from older people, So I don't get involved with my kids' stuff. I have actually seen a lot of studies where younger people, adult children, actually turn to their parents more than they turn anyplace else for guidance on finances. I found that that's very true. They typically do turn to you. But here's the thing. Think about what happens, and I've been thinking about this, Jim. I saw a commercial, and it made me really think a lot about, what we do in here. We spend a lot of time doing videos and doing education, and we have this on our website. Those of you who are clients of ours know that you go into this part of our website and you have all kinds of education on estate planning, how to get income in retirement, and all those types of things. But estate planning is a big deal. And you have a massive amount of money that is going to go from one generation to the next in the next coming years. And it made me think, this is something that we do a lot of work with people on, is how do you pass assets from one generation to the next, and making sure that your kids, your adult kids too, understand how markets work is critical, because they may inherit a bunch of money from you, and then just because they don't know what they're doing, why they're doing it, and they don't understand these things, they'll squander it.
Yeah, I mean, I'm just paraphrasing a stat that I've heard somewhere, but, just massive wealth tends to just disappear over like 2-3 generations.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.